I decided to definitely keep it short because the CPI numbers are in. As you know, this is inflation numbers. This is the big conversation. You got every there are, I think there was a survey done that 80% of households in America are talking about inflation ruining their lives or at least putting a negative impact on it. So I mean, was there ever another time in our lifetimes that we remember people talking about inflation as much as we are now, right? So it's a hot topic, and inflation numbers are out, and for the first time in 4 months, the numbers came in just as expected. So the idea for people to understand is, I've said this over and over and over again on every single platform that I speak on. If you're watching these numbers and you're trying to place bets or time the market, you can't time the market. But what you can do is understand how the markets react to this news. So probabilities changing of a rate cut, probabilities, let's say when I say the probability of a rate cut goes up and down, I'm saying that if the Federal Reserve is the ball game, everyone around them is placing side bets to see what's going to happen. You don't know. It's a bet, right? But what we do know is that the Fed's mandate is to get inflation back down to 2%. They want to create maximum employment for the United States of America. Well, right now, inflation peaked at 9.1%, and we're down to the 3.6% range. So what's happening is, on a month over month basis, is just over 0.3% that there was an increase. So the numbers are still being a little stubborn, but overall inflation has come down and came in exactly where it was expected to come in at. So this is a big deal because we know that, again, last October, interest rates were over 8%. And then by January, they were in the low to mid sixes, sparking lots of activity. And everyone's getting excited like, oh shit, we're getting back to normal. The paychecks are going to get fatter. I could buy a house. I'm doing what I got to do. Let's go. Right? The activity had picked up significantly. But by this month, even the end of April, we saw that interest rates had gone almost into just over 7.5% on a 30-year average, and activity had slowed down. These are all reactions. The Fed didn't change policy. They didn't change their plan. They didn't change their mandate. These were all just based on market predictions. So then what we saw last week was that the unemployment rate went up to 3.9%. That's 0.1%, sending the markets into a little bit of ease. Like, okay, the bond market is starting to pick up a little bit, not too crazy, but we're seeing some green on the screen. And as of today, with the CPI numbers coming in as expected, those numbers as expected are really big for the markets because they're saying, oh, okay, wait a minute, we're not higher than expectations. That means that, wait a minute, this might be taming a tad bit. And if it's taming, now the probability of a rate cut jumps significantly. And now we're going to see headlines talking about 2 rate cuts in 2024. And remember, we started with 6 rate cuts in 2024. Okay. So now we're back down to 1 to 2. So these are all really important things to understand. So this was a good report. This was good news. So what we're seeing is that maybe you can describe it as flattening. And this is going to send a signal to the Fed that we might be headed in the right direction. Jerome Powell did a very good job this week of reassuring people through his words. And I thought, wow, is it just me, or did Jerome figure out that his words are making a massive impact on markets and he understands what to say? I was saying this 6 or 7 months ago. All he had to do to tame the volatility in the bond market was make certain statements a certain way, because all of the reactions are to the statements. Because, for example, if you and I are on a date and we're having a conversation, you might say certain things that give me clues, and then I know what to get you for your birthday, right? So when people are listening to Jerome Powell talk, they're looking for those clues about when this is going to happen and when rate cuts are going to happen. Now, with all that being said, with having a little bit more confidence that rate cuts are on the horizon and that we're not going to backtrack and inflation is not going to continue to skyrocket in a quick manner, I think that there's a lot of good news there. But remember, rate cuts mean that the price of goods and services and borrowing and interest rates go down. And when the price of anything goes down, the demand for that goes up. So if you're a home buyer and you're out in the market and you're excited about rate cuts and excited about rates coming down, be ready, because that affordability crisis that you were struggling through with higher interest rates is going to definitely show up in the purchase price. So unless we have an extreme amount of inventory coming out into the market, you're not going to see that level out. On a final note, you will find there are lots of statistics out there that say if interest rates go down by 3% and home prices go down by 40%, or if your income goes up by 69%, we would then be back to pre-pandemic levels of affordability. And I'm here to tell you the three of those things are not going to happen. So choose wisely on what you wish for. We are excited to see more activity. We want to see interest rates get down. We want to see the American dream preserved through the idea of home ownership. We want to see young folk being able to afford home ownership. But asking for rate cuts prematurely can increase inflation and take us right back to where we started from. So we have to watch it closely, take it day by day, and be smart about, how we're interpreting the news.